Good morning, good afternoon, or good night to Mr. Rusdi and friends. I'm Anissya along with my colleagues Fikri and Fransisco from Group 7. Today we're going to present about cost analysis and activity-based costing for government, Part 2. Today's overview will be from Chapter 6 until Chapter 11, and I will start discussing Chapter 6, which would be measuring and improving efficiency, and continue on until Chapter 7, which is setting fees and charges. So for the first chapter, which is Chapter 6, we will be discussing about measuring and improving efficiency. Then what is efficiency? Efficiency is the accomplishment of objectives at minimal cost. It is also the amount of resources used to produce an output. It is frequently measured in terms of the cost for each unit of output. And cost analysis can be a powerful tool to measure efficiency for government programs. The four tools used to measure and improve the efficiency of government programs include unit cost analysis, standard cost analysis, intergovernmental unit cost comparisons, and also activity analysis. The first tool we're going to discuss is the unit cost analysis. So what is unit cost? Unit cost is the cost per one unit of good or service. The example would be cost per tree planting or cost per arrest. The example of use to measure improvements in efficiency would be a park maintenance crew might use the maintenance cost per acre to measure the efficiency of new maintenance techniques, so he or she could compare it. The indication, very high unit cost might indicate inefficiency, or low unit cost could indicate insufficient personnel and equipment. So then how can we calculate unit cost? Unit cost could generally be calculated by dividing the total cost to the number of units of output. However, the book also stated several specific key points when calculating unit cost. As an example, unit cost benchmark used to evaluate managerial performance should only include costs that managers could control. Next, how can we read unit cost data? If not used carefully, unit cost data could actually be misleading. Although higher unit costs are often associated with inefficiency and also higher total costs, it is still very possible that a program with higher unit costs is more efficient and also has lower total costs. When interpreting unit cost data, it is important to look behind the scenes to understand why unit costs have changed. Key questions that we could use to interpret the unit cost data include: has there been a change in the quality or amount of service provided per unit? Is another variable affecting unit cost? Are fixed costs a significant proportion of the total costs? If yes, what effect do the fixed costs have on unit costs? And lastly, is there excess capacity or the need to expand capacity in the near future? An example of another variable affecting the unit cost would be the unit cost of clearing snow may increase from one year to another, not because the decrease in efficiency in clearing snow, but could be because of the higher snowfall in the second year. Unit costs could also be misleading when they contain fixed costs. When a significant portion of the total costs are fixed costs, it is difficult to know whether a change in unit costs is due to the change in efficiency or a change in quantity. How we could avoid the misleading because inclusion of fixed costs include look at the change in total costs and also measure only the unit variable cost. In some cases, high unit costs may be due to a recent expansion in capacity and may suggest excess capacity that is being underutilized, while unusually low unit costs may suggest the need to expand capacity in the near future. A standard cost is a unit cost in normal or optimal conditions. In other words, standard cost is what the unit cost is supposed to be. In the government sector, standard costs are usually set by each individual government. The standard is based on either historical data or the judgment of individuals familiar with the organization's costs. Standard costing is appropriate with repetitive services such as tax payments, in which the work performed is the same for each unit of service. How to do the standard cost analysis. So first, we have to determine the standard costs. Second, we have to calculate the flexible budget by multiplying standard costs with actual quantity. And third, we have to do the variance analysis by comparing differences between the flexible and actual budgets to pinpoint inefficiencies in each specific line items. There are three approaches in determining standard costs. First is historical averages, next is normal operating conditions, and lastly is optimum conditions. Here are the strengths and weaknesses to compare. The variance analysis can be used to examine whether differences between the flexible and actual budget are due primarily to one of the following: change in the quantity of output, change in the quality or amount of service provided for each unit, change in efficiency, and also change in prices. An alternative to benchmarking unit costs against an internally generated standard is to compare the unit costs with other governments who provide the same services. Several programs have been developed to collect and compare performance measurement data and cost data across governments. Here are some examples. You could see more examples in the book. These are some factors that need to be considered when you want to compare the unit costs between governments. There are a lot of differences such as cost accounting, capital assets, geography that need to be considered because they can create problems. Also, output measures do not necessarily provide information on outcomes and quality of service. And lastly, unit cost comparisons show a government how it is performing relative to its peers instead of to an ideal standard. The activity analysis tries to uncover the inefficient or unnecessary activities that cause the costs. If these activities can be made more efficient or eliminated, then efficiency can be improved permanently. Steps of activity analysis include drawing a detailed diagram or process flow chart of the steps involved in providing a service, classifying each activity in the process as a value-added or non-value-added activity, finding ways to eliminate non-value-added activities and improve the efficiency of value-added activities. Value-added activity is an activity that increases the value of a service to customers and vice versa for non-value-added activity. Now let's move on to Chapter 7, which is the setting fees and charges. Fees and user charges generate revenue and send important signals on user demand. They also enable a government to control how a service is used and carry out public policy, and they provide a means of financing that is fairer than taxes. The Government Finance Officers Association and the National Advisory Council on State and Local Budgeting both recommend that governments develop a formal policy on setting fees and charges that should follow several characteristics, as you could see on the book. However, the 4 basic questions on setting fees include: is a fee appropriate for the service? What is the primary purpose of this fee? What is the full cost of the service? And also, how do market factors, political factors, or broad policy goals affect the amount of the fee? This is the more detailed fee setting process guidelines. And as you can see, when setting the fee based on the primary purpose of the fee, there is the collecting revenue purpose, and one of them is recovering the full cost of the service. As an alternative to the full cost method, there are 2 other methods. These are the 2 alternative methods: direct and indirect costs, and also fixed and variable costs. So the direct and indirect costs is useful when a government wants to calculate the full cost not only someday, but when the government must meet its cash flow needs. The fixed and variable costs formula uses the break-even formula, and hence the advantage of being easier to adjust to change in demand, and the flexibility with the break-even formula also enables the government to ask what if and adjust the formula accordingly. In recovering additional costs caused by additional users of a service, using the marginal costs method could be useful. The marginal costs is the increase in costs caused by a particular action. Advantages for the government could be keeping a subsidy from increasing because the users would still have to pay for the additional use. It is simpler to estimate than full costs because we do not need to allocate indirect costs, and also could be more fair. An example of the marginal costs is extending pool hours from 5 to 7 p.m. The marginal costs to be calculated would be the staffing and operating the pool only for these 2 hours. Other important aspects we need to consider is how do other factors affect the amount of the fee. In some cases, a fee may be set too high in an attempt to generate more revenue, but it is important to realize that increasing the fee would not necessarily increase the revenue, but sometimes could also decrease the revenues. because the citizens sometimes are not willing to pay higher than the original amount. Next, political factors should not be the primary consideration when setting fees. Lastly, after a fee is set, governments should review and update it periodically to adjust for changes in inflation, market conditions, and government policy. In addition, governments should conduct a review of the cost analysis and assumptions that the fee is based on.
Chapter 8: Make or Buy Decision. An efficient and effective government service calls for an efficient and effective cost. That is why governments face make or buy decisions. Governments can contract the service to a private firm, non-profit organizations, or other governments. Private firms and other governments offer similar services as local governments, whereas non-profits are for certain human resource services. To decide between making or buying, the chapter uses cost analysis. Other than cost, quality of the service, government's ability to control the service, government's ability to evaluate the service, the impact on government employees, customers, and taxpayers, and statutory and regulatory issues should be considered. We should remember that first, to evaluate contracting, we should use a differential cost perspective, and secondly, cost comparison should cover a multi-year period and discounted future cash flows. The differential cost perspective is a concept to demonstrate how a decision will change a government's costs, because totaling all costs may include fixed costs that cannot be saved, even if the service is contracted out, which makes the government look more efficient when it isn't. Costs to keep in mind are sunk costs and opportunity costs. Sunk costs should not be included in a make or buy this cost analysis. It is a cost that has already occurred and it won't be affected by the decision. For example, project feasibility survey costs, consulting costs, etc. Whereas opportunity costs, or the opportunity foregone when choosing an alternative, should be included in the cost analysis. For example, a government is deciding between using an unused government land or purchasing another land for a certain project. As we can see, including opportunity cost is important here, because if it isn't included, an option A or using city land is cheaper, but the city or government land could have been sold for $2.3 million as the opportunity cost of land. Let's go back to the second point. Cost comparison should cover a multi-year period and discounted future cash flows. As students, we know from the financial management course that DCF analysis is useful to evaluate the value of a certain project. In terms of make or buy, this is needed as a multi-year analysis can provide information on whether or not a contract will provide long-term savings. Secondly, it creates more competition as it should be more attractive between potential vendors. To build a make or buy cost analysis, there are four main steps. First is to define the service. Second, to calculate the in-house costs that could be avoided by contracting out the service. Third is to compute the total cost of contracting out. And fourth, comparing the cost that could be avoided with the cost of contracting out. The first step in building the analysis is to define the service, meaning to specify the quality and quantity of the service and output and outcomes that are expected. This gives the apple-to-apple comparison between options, as an alternative could appear much more costly when in reality it offers more services than the others, and vice versa. The second step is to calculate the in-house costs that could be avoided by contracting out the service. In this step, there are two things that should be done. First is to itemize the full cost of the service, including all the direct and indirect costs. Then, use the list as a basis to determine the cost that would be saved if it is contracted out. The costs that can be saved are further divided into two. First, the cost that can be eliminated immediately, and the cost that can be eliminated after a transition period. The third step is to calculate the total cost of contracting out the service. This includes, but not limited to, the bid from the contractor, the contract administration cost, the transition cost, and finally minus the additional revenue generated from contracting out. In order to be consistent, only new costs should be counted, and old costs that would be incurred regardless of the decision should not be counted. As stated before, you must calculate the contract administration cost, which is the cost of selecting and managing a vendor through the life of the contracts, which may include reviewing and evaluating RFP or request for proposal, writing and negotiating a contract, processing change orders and amendments, monitoring and evaluating vendor performance, processing payments, and etc. Usually, the contract administration cost is around 0 to 25%, and one way to estimate it is to simply imply 10 to 20% of the contractor's bid as a reasonable range. However, there is a standard formula used below. Secondly, we must also calculate the transition costs, which are costs that the government incurs when it makes the transition to outside contractors. For example, when transitioning to a contractor, existing employees might need to be laid off, and there are costs such as unemployment compensation, accrued vacation benefits, and severance pay as the transition costs. Transition costs could also be the preparation of facilities and equipment to be used by the contractor. After factoring in transition costs, additional revenue that a government collects should be subtracted from the costs, as there can be an increase in tax revenue when a government contracts out a service. Other than that, sales of fixed government asset can also be one of the revenue that a government collects. The fourth and final step is to calculate the difference between the costs that are saved and the costs that are generated by contracting out. If costs that are saved are higher than the cost of contracting out, then it's a good decision to contract out or buy instead of make. As a final resort can be based on assumption, sensitivity analysis can be a tool to test the amount stated in the analysis with regard to the assumptions. Also, non-financial matters should also be considered after calculating all the difference. As already stated in the beginning, there are several considerations that needed to be factored in, including quality of the service, government ability to control the service, government's ability to evaluate the service, impacts on government employees, customers, and taxpayers, and statutory and regulatory issues should be considered also. That's it for the chapter 8. The next is chapter 9. Chapter 9. Changing the level of service. Local governments must decide whether to expand or reduce funding to various programs or changing the level of service, as budgets as well as external situation can be changing every season. In order to analyze the cost or saving of increasing or decreasing the level of service, there are three approaches that can be used. First is the marginal cost analysis, second is cost behavior approach, and the third is average costing. Marginal costing measures the increase or decrease in cost due to a change in the level of service and only focus on the change. This approach does not calculate the two total costs for two different service levels. It calculates the difference between the two by estimating the cost that will change with the change in service level. To calculate the marginal cost of an increase in service, firstly, itemize all of the additional requirements, then convert them to a dollar or rupiah amount by multiplying the unit cost. Finally, add all the costs together and add or subtract changes in fixed costs caused by the change in service level. Secondly, Cost behavior analysis. Cost behavior uses the concept of fixed and variable cost. As we know, there are two behavior of cost, fixed and variable. Any cost can be made to an equation using the formula y equals mx plus b. The y variable is the cost, the m variable is the variable cost per unit, and the x is the unit amount, and the b is the fixed cost. To calculate the change in cost, simply substitute the x or the unit amount output in the variable. Aside from the two methods, there is also average costing. Average costing uses the current unit cost to estimate the amount of total cost with a different output level. To calculate the average cost, divide the total cost with the number of units of service. For example, 1 million rupiah divided by 100 customers, which amounts to 10,000 rupiah per customer. And then changing the amount of output and multiplying it to the previous rupiah or dollar amount per output. Out of the three, average costing is relatively more simple. And if we look into it further, average cost assumes that all cost is a variable cost. When there is a significant amount of fixed cost, average cost distorts the actual change as fixed cost does not increase with the amount of output. When there is a deficiency in capital capacity, meaning there is a need for capital expenditure when increasing level of service, average cost underestimate the total cost as it does not factor in the capital investment needed. On the other hand, when there is excess in capital capacity, the average cost overestimates the total cost as there isn't a need for increasing in fixed cost. That's it for chapter 9. Chapter 10 will be continued by my colleague Fikri Haidar. Thank you.
Moving on to the purchasing capital equipment or the first chapter. So to compare the capital equipment's accurate prices, it is recommended to use the life cycle costing system. So life cycle costing system provides a means to analyze and evaluate all other factors that affects the capital equipment's cost. It also totals the cost that relates to the ownership of an item, such as the acquisition cost, maintenance cost, and operational cost, and then lastly to be deducted by the resale value. It also predicts the future maintenance and operational cost of the equipment. It is not suitable for some type of procurements, such as short-living items, services, and items with negligible maintenance and operational costs. So this is a flowchart for selecting a procurement method. So the first one is you need to ask yourself that are there any significant logistics that cost that associated with the product to be procured? If it is yes, you should estimate the impact that the variation in product characteristic between vendors and maybe have on logistic cost. If it's not, are there you need to ask yourself that are there physical or functional characteristics that are likely to vary significantly among alternative products? If it is no, and the answer is no, you could use price competition as your procurement method. If it is yes, you should estimate the impact that the variation in product that I already stated before, and you need to move on to ask yourself that is there any significant difference in logistic cost between vendors' product, and if there is no, and the answer is no, you straightly use the price competition procurement method, and if it's yes, you need to ask yourself again that is there any difference in price? Whether is the difference in price greater than the logistic cost advantage added by the source selection cost? If it is yes, if it is no, you could use sole source method. If it is yes, you need to again ask yourself that is the expense of analyzing logistic cost is justified? If it is no, you could straightly use the price competition method. And if it is no, you need to calculate that is the price added by the logistic cost is greater than the logistic cost advantage added by source selection cost and added by the expense of analysis. If it is no, you could use sole source method. And if it's yes, you finally can use the life cycle cost competition procurement method. So there are 10 categories of the life cycle cost: the source selection, acquisition, maintenance, inventory management, training, inspection and acceptance, transportation, documentation, operation, and disposal. So moving on to the next one, it is discussing to how to calculate the life cycle cost. In the table and the exhibit, you could see that there are 4 steps to calculate it. So the first one is estimate the useful life of the item. So if you decided that it is a 6-year useful life in the example, moving on to the estimate the future cost. So the future cost, you could the category you could see at the previous slide, this one, and you could add it all and estimate it, and the total will be the gross total. You could total it in each year. So you on the next one is you need to calculate the net present value with the with the sorry with the formula below. And lastly, you could calculate the average yearly cost by calculating the net present value divided by the number of years of the useful life, and you will get the average yearly cost. Okay, so moving on to the 11th chapter, buying in bulk chapter. So the buying in bulk is a method to reduce the cost per unit by purchasing in a large quantity. It could also increase the cost per unit depending on if you consider the storage, the interest, and insurance costs. So, for example, if you buy a 3-year supply of food or ready-to-eat food, instead of buying per year, it will require you a larger amount of storage, right? So you could decide that whether it would be necessary to add a storage facility or to rent more space, or it could use a space that it is free. So to find whether the cost saving activity, so we should consider these factors such as price per unit, whether the price per unit will be reduced if we use the buy in bulk method, the storage cost, as I mentioned earlier, whether we need to rent a space or build a larger facility to contain the storage, inflation cost, whether inflation or deflation in the future will affect the price per unit of the good. And last one is the cost of money, whether the money that you use to pay upfront could be used as an investment, and how much the interest will be gone if you use it to pay the storage upfront. So the cost analysis concept that could be used to evaluate the bulk purchase is a differential cost analysis, or it could also use the NPV analysis, as it usually involves a trade-off between paying upfront and paying over time. So in this exhibit, it shows a comparison between two different transactions that it differs the unit cost of a 1-year purchases versus a 4-year supply of cost. So as you can see that the the top one is the buy as needed graph, and the bottom one is the buy in bulk table. So the cost item is different, as the buy in bulk price, it could be reduced to $30 per ton, as in the buy as needed table, it's only $40 a ton. So it both have the same amount of goods. Both of them are 8,000 tons, and the difference is the first one is yearly payment and buying at a 1-year period, and the second one is buying in bulk, paying upfront in the first year now. So as you can see, the difference is in the storage cost and the insurance cost. Buying in bulk have a larger, have much higher storage cost. It is 3 times as much as the buy as needed storage cost. But as you can see, the in buy in bulk, we don't need to expend more money to buy the items as it is already paid upfront. And you can see the difference in comparison if we use the NPV analysis that eventually the buy in bulk is way cheaper than the buy as needed method. It have 20,000, 24,000, $24,000 difference. So that is all for our presentation. Thank you very much, and feel free to give comments and questions. And let's have a discussion in the class. See you in class, guys. Thank you very much.